All right, class, welcome. Today, we're going to get into what I consider the single most important concept in all of finance and accounting. And I want to be clear, this is not just some formula you need to memorize for the next exam. This is the fundamental logic, the very grammar that governs every single business on the planet. You can really think of it as the financial DNA of a company.
So let's start with that idea. What single concept could possibly describe the financial state of a tiny startup? Like a coffee cart on the corner, and a massive global corporation with the same elegant logic? Well, the answer, as you've probably guessed, is an equation. And its true power isn't just in the math, but in its perfect, unwavering balance.
So here's our game plan for today. First, we're going to establish exactly why we call this the language of business. Then, we'll deconstruct each of its core components piece by piece. After that, we'll see it in action, see how it moves and breathes with some real-world transactions. And then finally, and listen, this is the most critical part for your future careers, we're going to see how managers use this equation every single day to make incredibly important strategic decisions. Okay, let's get right into it. To understand why this equation is so important, you have to realize that it is the absolute bedrock of the entire double-entry accounting system. That's the global standard that businesses have used for centuries to report their finances. It's not a new idea, it's a profound one.
And here it is. Assets equals liabilities plus equity. Now, I really want you to see this not as a math problem, but as a statement of pure, simple logic. The left side, assets, is all the stuff the company controls, its economic resources. The right side tells us where the money came from to get all that stuff, and there are only two places it can come from. It was either funded by debt, that's money we owe to outsiders, our liabilities, or it was funded by the owners, which is the equity. There's no third option. Every resource has a source. Every dollar has a story. And that is why it must always, always balance. It gives us a perfect snapshot of a company's financial position at any single point in time, which we call the balance sheet.
So now, let's deconstruct each of these three crucial components. To make this tangible, to get it out of the world of abstract theory, we're going to use a simple hypothetical business that we can all wrap our heads around. We'll call it Clara's Coffee Cart.
First up, assets. Now, the formal definition you'll read in a textbook is resources controlled by the company which are expected to provide future economic benefits. Let's really break that down. Controlled means the business can use the asset and get the benefits from it. Future economic benefit is just a fancy way of saying it has the potential to help you make money down the road. Now, a critical distinction managers have to make is between current assets, things you expect to use up or turn into cash within a year, like your inventory, and non-current or long-term assets, like your buildings and equipment, which are going to provide benefits for many, many years.
Okay, so let's apply this to Clara's Coffee Cart. Her cash and her inventory of coffee beans and milk, those are absolutely current assets. They are essential for her day-to-day operations, and they're going to be converted into cash very quickly. But the espresso machine and the cart itself, those are non-current assets. They're long-term investments that she's going to use for years and years to generate revenue. All of them, though, are resources she controls to create future value.
Next, we have liabilities. These represent the claims that creditors, outsiders like banks and suppliers, have on the company's assets. A liability is a present obligation that came about because of something that happened in the past. And just like with assets, we classify them. Current liabilities are debts that have to be paid within 1 year, like the monthly bill from your coffee bean supplier. Long-term liabilities are obligations that are due in more than 1 year, like a 5-year bank loan. And believe me, knowing the difference is absolutely crucial for managing your cash flow.
So for Clara, the money she owes her coffee bean supplier, which is probably due in 30 days, that's a classic example of a current liability called accounts payable. But if she took out a 5-year loan to buy that expensive coffee cart in the first place, that would be a long-term liability. Both are claims that outsiders have on her business's assets.
And finally, we get to equity. Now, I want you to pay very close attention to this definition. It's the residual interest in the assets after you've subtracted the liabilities. This is an incredibly profound concept. It means the owners get whatever is left over. If the business is a huge success and its assets grow way faster than its debts, the owner's equity grows. But if the business struggles, well, the creditors get paid first, and the owner's equity can be completely wiped out. That's why you'll sometimes hear equity called the risk capital of the business. The owners are taking the biggest risk.
Clara's equity is going to come from two primary places. First, there's the capital, the money she invested from her own savings to get the whole thing started. Second, they're the profits she earns and then decides to keep inside the business to help it grow. We have a name for that. We call it retained earnings. This perfectly shows how the success of the business directly increases the owner's stake, rewarding them for that huge risk they took. Okay, so now that we get the components, let's see this equation in motion. It's so important to understand that this isn't some static photograph you take once a year. It is a dynamic, living, breathing system. Every single transaction, from selling 1 cup of coffee to taking out a huge corporate loan, causes a change somewhere in that equation, all while maintaining that perfect, beautiful balance.
This right here is the heart of the double entry system. For every action, there is an equal and opposite reaction somewhere in the equation. A really common mistake students make is they only record one side of a transaction. If you forget that second entry, the entire system just falls apart. So let's see how it works.
Let's analyze this transaction. Clara goes to the bank and secures a $10,000 loan. We have to identify the two effects, always two. First, what did the business get? It got cash. Cash is an asset, right? So the asset side of our equation just went up by $10,000. Second, what did the business give up or promise in return? It promised to pay back that loan. That promise is an obligation, a liability. So the liability side of the equation also increases by $10,000. And look at that. Assets equals liabilities plus equity, perfectly in balance.
So why does all this matter to you as a future business leader, a future manager? Because understanding this balance allows you to see the financial consequences of every single decision you make. Let's step away from pure accounting theory and look at a practical business choice that Clara has to make right now. This is a classic managerial dilemma. A new, better machine could increase her sales and profits, but how she pays for it has huge strategic implications. Understanding the accounting equation allows a manager to see the trade-offs of each option with absolute crystal clarity. Okay, let's put on our manager hats and analyze this. Option A, we pay with cash. How does this hit our equation? We're exchanging one asset, cash, for another asset, equipment. So our cash account goes down by $2,000, and our equipment account goes up by $2,000. The total value of our assets is exactly the same. Liabilities and equity, untouched. What's the upside? No new debt? That's great. The downside? We've just reduced our liquidity. Liquidity is just a measure of how easily we can pay our short-term bills. Cash is our most liquid asset, so spending it might make it harder to pay our coffee supplier next week. Now let's look at option B, taking out a loan. Here, we get the new machine, so our assets increase by $2,000. But we also just took on a new debt, so our liabilities also increase by $2,000. Our cash position? Unchanged. The upside here is we preserve our cash, our liquidity. The downside, we've increased our leverage. Leverage is using borrowed money to acquire assets. Now, leverage can be great. It magnifies your returns, but it also magnifies your risk. Now, Clara has another loan payment she has to make every month, no matter how many cups of coffee she sells. So you see, the choice isn't really about the machine. It's a strategic trade-off. Do we want a strong liquidity position with no new debt, or do we want to preserve our cash by taking on more financial risk and leverage? The right answer depends entirely on the company's overall strategy and its current financial health.
Okay, to wrap things up, let's crystallize the absolute core principles of everything we've talked about today. If you can internalize these rules, you will avoid the most common mistakes I see students make when they first start to analyze financial information.
Please, remember, these are not just abstract rules for your exam. The equation must always balance, no exceptions, no excuses. For any transaction, you have to find that dual effect. What did you get and what did you give? And always remember the fundamental story it tells. Assets show what you have, and liabilities and equity show who has a claim on what you have, either the lenders or the owners. This isn't just about bookkeeping. This is the pure, unadulterated logic of how any business is built and funded. And that, right there, is the most important thing to take away from our time together today. Never, ever forget that. When you can look at a business decision and instinctively trace its impact across assets, liabilities, and equity, you have graduated from just memorizing a formula to truly speaking the language of business. You've gained the ability to make intelligent, informed, and strategic decisions. So as you go forward, for every business headline you read, from a startup raising money to a huge corporation buying another company, I want you to ask yourself, how did that decision affect the accounting equation?